That is the last part for taxation, whereby we have looked at employment, we have looked at company, we have looked at partnership. Now we look at this one for capital allowances or investment allowances. We shall be done with the taxation part. And for the investment allowances, they are normally granted. These are capital allowances. We have different names. Whether you talk about capital allowances, we could talk about the capital deduction, but currently the right word is investment allowance. They are granted to investors. They are granted to investors with an aim of reducing the tax liability. It is normally part of capital planning. When you talk about part of planning, tax planning, claiming the capital allowances, claiming the capital allowances. And when you claim the capital allowances, then your taxable income will reduce because capital allowances are allowable expenses. They are allowable expenses, and they normally reduce the tax liability. So I'll just take you through what you are normally given in the paper. What you are normally given in the paper. Yeah, in the paper you are normally given this part, the front page. Yeah, this is a BDA, the paper for BDA. It includes the part for taxation, for employment income, and the part for personal relief, what we were covering, and the part for investment allowance or capital expenditure incurred on the rate of investment and the residual value. So for the residual value, we have different rates, but majority is 25% per annum on equal installments. So for this capital or investment allowance, they are categorized into buildings, machinery, purchase and acquisition of rights, right to use fiber optic cable by telecommunication operation, etc., and farm works. But ideally, when we look at capital or investment allowance, we normally have the three categories of investment deduction, industrial building deduction, and the what? And the wear and tear. And the wear and tear, those are the major three. The main one, we normally have shipping investment deduction, and also the farm works deduction. And remember now the rates changed. Yeah, the rates that we are current keep on changing, which keeps on changing. You'll find that you need to under the old regime where we until we had four categories, class 1, class 2, class 3, and class 4. Currently we don't have all those categories. When ID was 100, currently ID is 50%. Like for the buildings, if we are looking at classification of building, hotel building, building used for manufacture, this we call it factory building, hospital building, petroleum or gas storage facility, education or hostel building. Also for the first one, the first four buildings, they qualify for ID at the rate of 50% in the first year of use. Second and subsequent year, we shall calculate based on 25%. 25% of the residue, the balance, 50%, assuming it was 2 million, 50%, 2 million. Second year, we take the balance of 2 million by 25%, spread it over that particular period that is remaining. Then, we're dealing with education or hostel building and commercial building. This one, they are at the rate of 10% per annum on straight line basis, just 10%. When you talk about straight line for a period of 10 years, you'll claim it 10, 10, 10 for a period of 10 years, 10% per year on straight line basis. Then for machinery, those are buildings. For machinery used for manufacture, these are manufacturing machines, 50% in the first year. Hospital equipment, 50%. Ships or aircraft, this one is under the shipping investment deduction. Ships or aircraft, 50% in the first year. And remember, when you talk about the first year of use, the residue will take what? The balance of 25%. Residue takes the balance. Second and subsequent year, we shall be calculating the balance. 25% of the balance, because that's what we're referring to as a residue. Motor vehicle and heavy earth moving equipment, 25%. This is the one that initially was class 1. Currently, we talk about just category 1. Yeah, category 1, 25% per year straight line. Computer software, calculators, copy and duplicating machine, These were items that initially were in class 2. Currently, we talk about still category 1 because the rate is the same at 25% per year, straight line. Furniture used to be in category or class 4 at 12.5. Currently, is at 10% in furniture. So that's the second category where until we have only two rates. It's either 10 or 25. So it is easy to categorize them into category 1 and into category 2, 25% and 10%, instead of creating the four classes with the same rates. Just reduce the number of classes. Then we are dealing with telecommunication, 10% on straight line, film equipment, 25%, machinery used to undertake operations under prospecting, this mining allowance, 50% in the first year and 25% in the second year. Other machinery that are not used for manufacturing, that is 10% on straight line. Then we have the purchase or acquisition of right to use fiber optic cable by telecommunication operation, 10% per year on straight line basis. And then we have the farm works, which is 10% for the first year of use. 10% for the first year of use. So those are some of the items that you have been given, but remember they are normally limited. You need to know the other areas that you need. Like when you talk about a saloon car, we normally restrict the value. Currently it's restricted at 3 million. Initially it was 2 million. Currently it is restricted at 3 million for non-commercial vehicle. Specifically for saloon car, any amount above 3 million will not qualify for investment allowance. The maximum amount is 3 million. 3 million. And I think it's the only one that with the restrictions. The others do not have the restriction. So that is the investment. The others we shall look at them as we move on. But just know the former ID, the one that you're calculating formally, the ID, they remain, but now the rate remains at 50%, not 100% for the first year. Here is 50% for the first, then second and subsequent, you lower the rate to 25%. That is for the hotel building used for manufacture, hospital, petroleum, education and commercial, they are at 10%. Machinery that are heavy or the one that are used for manufacturing, again they go with 50% together with the ships and aircraft. But the other machinery again for operating, the mining still is at 50%. So those are some of the items and their specific rates that we have there. So that we shall look at an example to illustrate that. Let me share example. So we have a small example here. So we have two questions only. I've included the question for last sitting that was tested, and I've included a new question that we shall look at, just a simple question to start with for the investment allowance. So currently be at investment allowance 2 in that particular workbook. Investment allowance 2. Investment allowance 2, we start with that one. And this workbook has got a question on partnership. Those are part of the question that we'll attempt, part of the questions that you will attempt. So today we are just dealing with investment allowances or capital allowances. So I'll read through this. So Fountain Limited manufactures soft drinks for sale in the local market. The company started operation in January 2021 and acquired constructed the following assets. We have the asset, year of acquisition and construction, cost of acquisition / construction. What we incurred to acquire or to construct if the items we were constructing. And we are required to compute the investment allowance for Fountain Limited for each of the 2 years ended that 1st December 2021 and that 1st December 2022. So we are calculating for 2 years. 2 years, 21 and 22. 1 and 22. For 2 years. Do we have a schedule? We need to have a schedule. Normally have a schedule. Normally the one that has a schedule is the wear and tear, but even these others, it's just but a simple schedule. We shall illustrate using these. We'll use this example to illustrate how you are supposed to go about it. We'll illustrate I'll illustrate using this example the schedules that you shall use. Simple schedules which are not complicated to use, because you need for 2 years. So you can start with investment allowance or investment deduction. Sorry, investment deduction. Just for classifying them correctly. You normally have the details, qualifying cost, then you calculate ID at 50%, so ID in this case is investment deduction, ID at 50%, and whatever we get is residue, and we calculate ID at 25%, the balance, investment deduction second and subsequent year, 25%, and we get the residue. That way. So this is a simple schedule that we have. That way. The details, qualifying costs, ID, the residue is a balance. So this is for the year 2021, and this one is for the year 2022. The year 2021 and for the year 2022. Remember, ID, the first year is 50%, second and subsequent year is 25%. So the items that here they are qualifying, we don't have any additional information to explain a lot of things. So we have, let me just separate these using the 1000 separator to become easier. So the first thing we have is the factory building. Factory building normally qualifies for investment deduction. Factory building qualifies for investment deduction at 50%. Our qualifying cost is the cost that we have been given. Remember, we acquired it in 2021, meaning the first year we shall take 40, this value, multiplied by 50%, that way, by 50%, and I will enter, meaning the first year we shall have 20. The balance that will remain will be 20 minus the residue minus the ID, we remain with 20 being the residue. So the second and subsequent year we shall calculate on that 25%. Second and subsequent year, 25% of the residue. Remember, now this is a straight line. We'll be basing on the residue, not this one. The first residue is what we'll be basing on when you're calculating the other for 25%, and you get the residue. So the residue is now 15. The residue is now 15. Remember, the rest we shall be calculating based on the residue, straight line. We are saying on equal basis. If it is 2023, we shall still based on 20. 2024 based on 20, not on reducing now, is based on the residue, the balance that remains. We spread it over the period, because 25% is just 4 years, within a period of 4 years. Like here, already our residue is 15. 2023, 50% will be 5,000. You minus here, you remain with a residue of 10. 2024, you remove another 5, you remain with 5, and 2025, you remove 5, you remain with 0. So that way, the second and subsequent is 25% on the residue, the first residue value that we get. Factory machinery, the same category. Here, can drag this so that you get 12,500. This one already you have calculated. Just need to drag what you have done to get those values, and even this one, and even this one. Just drag and you'll get your values. So you can see this one is a minus E21, This on the residue minus the tax, and you get your value for the factory machinery, which qualifies still for ID. So the lorries now will qualify for the other item, that is the wear and tear, go down wear and tear, computer wear and tear, computer software wear and tear, saloon car wear and tear, and other machinery still on wear and tear. So these two are the only items that are qualifying for investment deduction. The only items that are qualifying for investment deduction, and we get the total of the ID. ID that will be claimed for 2021 is 26 to 50. For 2022, we shall have 500. That's the amount that will be allowed as an expense, allowable expense. Then wear and tear. Schedule. So for wear and tear schedule, we just summarize to have category 1, and category 2. Category 2. So for category 1, you can add something here. I put a hyphen, 20%, 25% for category 1, hyphen 25%. For category 2, hyphen, which is 10%. Items that falls under category 1, they will be calculated at 25%, the wear and tear. And items that falls under category 2, they will be calculated at 10%. Initially, when we had 4 classes, the first 3 were condensed to form one class. Yeah, they were combined to form one class at 25. Remember, the initial rates were 37.5, 30, and 25, but the 3 of them, they have been consolidated to form one at 25. The one that was 12.5 now is at 10%. So the other category that we have, we shall have the lorry. We shall have, I think that's all. First, lorry up to saloon car. But now for saloon car, we shall take the restricted, what we call the qualifying amount. So for the lorry, 2 lorries, these are at 25%. I think we have seen that. The lorries. So go down does not qualify for this. Sorry. Go down will go with what we call the IBD. So computer 800 and software the same. Computer and computer software, they are in the same category. So for the saloon car, we have said the restricted value is 3 million. 3 million, so 2 of them will be 6 million. Remember here they had added at 3 point. They had added at 3 point, but you'll find that reduce as 0. Yeah, 6 million, 3 million each is what is restricted, 3 million each, which gives you the 6 million. Then you have what we call, after that, 2 saloon car, we have other machinery. Other machinery is at 10. We have seen that. Other machinery, we are just picking the value here directly. Other machinery, but other machinery, just a minute. These 2, allow me to delete, because those 2 are for 2022. The saloon and other, those are for 2022. So for 2021 was lorry, computer, and computer software. Only this. To get qualifying amount, qualifying amount is only for the first area that we have, and we calculate the wear and tear. So the wear and tear will be 25% of this. 25%. We need to put a negative sign because we minus that way. And the total of the 2, yeah, you get it, the 2. This one we call it written down value. Written down value, carry down. Written down value, carry down. Yeah, that way. That is for the first. Remember, category 2 we had nothing. Category 2 in this case we had nothing. So that for the second now, second and subsequent, remember that was first year at 25. And when you look at these, they are saying whenever you are dealing with wear and tear, the one for 25, it is 25% per year on straight line. The motor vehicle, heavy moving machine, computer software, calculators is 25% per annum on straight line basis, not on net book value. But we are dealing with the straight line, straight line basis. So this is wear and tear for 2021. Yes, for 2021. We need now to calculate for 2022. For 2022, we shall start with the same items, whatever we had, because we are dealing with the cost. Yeah, the cost. If we are dealing with the cost, we are not dealing with the written down value. Remember, written down value is reducing balance. Yeah, here the balance, written down value brought down, or let me just call balance brought down. Balance brought down. Balance brought down. Brought down at cost, because we need them at cost. I'll pick these. The qualifying amount is what we shall start with in the second period. That is what we shall start with, and we include the other, including the two saloon car that we have said the qualifying is territory, which will be 6 million. 6 million each. 6 million. Then the other was other machinery. Other machinery I've said is category 2. This one at 300. I think that's all. Computer. So apart from go down we shall calculate. Apart from the go down, so farm machinery, factory building, I think all of them, factory building and factory machinery were already included in the investment deduction. So that's all for 2021 and 2022. So we calculate these before we go to the next. Qualifying amount. So the total here, qualifying amount, yeah, that way, and we deal with this one. That is our qualifying amount. Wear and tear for 2022. So here we have the top border, that way. So for 2022, we take this still by 25%, and we take this now by 10. By 10%. The second category at 10%. Get the written down value. Written down value. Yeah, this one is for 2022. Written down value for 2022. So this one we were supposed to include a negative, negative sign. Even this one was having to carry a negative sign, so that the total that we shall have is without, that way. That way. And you'll use the top and bottom border. So that is the wear and tear schedule for the 2 years, for 2021 and for 2022. The key thing is the wear and tear, the one that we are calculating, the one for 2021 and the one for 2022. And remembering that initially, remember, we are using the net book value, whereby we were calculating based on written down value for the previous year. But in this case, we are going back to the carrying cost or qualifying amount, being the amount that we are basing our wear and tear on. We have IBD, industrial building deduction. IBD, industrial building deduction. IBD So for IBD, we have the details. I think we had the same amount like what we had here. These details, and I will go across that way. But in our case, we shall have qualifying amount. This one will be IBD at 10. IBD is 10% at 10%. 2% is there. Just need a general or number. Okay, so IBD at 10%. Okay, so you're not supposed to include the equals. Just that way. IBD at 10. It is opening other items. Yeah, and we don't require, it was only for 1 year. So IBD, they go down was for 2021. So we shall calculate for 2 years. And again, that one is based on straight line. Based on straight line, 10% each year, 10% each year. So we shall have IBD. So this one will be for 2021. This one will be for 2022. So this one shall have IBD at 10% that way. So that here our details only have one item. They go down, only they go down, and the qualifying cost of the go down was 4.1. So IBD at 10 because we don't know the dates, but you know it was at 10, 4.1. This one by 10%. We get the residual, which is a balance. Yeah, we get that. So for 2022, when you look at the go down, you just reshare this document. When you look at items like furniture, items like what for IBD here, they have not shown it directly. Like commercial building, 10% per year on straight line again. Yeah, straight line basis. Just use the costs. We shall calculate based on the cost. So that for that one, we shall have here, we shall take our cost, the qualifying cost that we had. Again, we multiply by 10%. Which will give you still for 10. But what will change now is the residue. The residue brought down was at 690, and you minus the IBD. So the residue carried forward battle, it will be now 32.8. But the IBD will be a constant year in, year out, because it's 10% of the original cost. It is on straight line basis, not on reducing balance. And that is the first part. We did not have any other thing. Yeah, first part we have calculated for 2 years. Yeah, this one is for 2021, this one is for 2022, and their residue, the residue value. Remember, residue is a balance. When we talk about the residue, is the balance that remains after we have provided for the first period. That balance that remains, that is not yet, we have not claimed the capital allowance, is what we are taking forward to claim for the next particular period. We look at the second part of it, which is the investment allowance 1. That was first question. To look at investment allowance 1. Hoping this one you have understood, unless there is a question or any clarification based on this one for Fountain Limited. Question or clarification, just use a box, or you can just unmute and ask. so that we look at the one from Musemi. If you're done, if investment allowance 2 you don't have a question, then you can go to investment allowance 1 for Musemi. Okay, so I'll read through. It was one that was tested last sitting. It was there, question 25 for taxation. It's question 25 for taxation. And it reads, Musemi, an electronics engineer, retired from active employment in the year 2021. He set up a factory in Thika on 30 September 2021 to produce mechanical and auto spare parts at a cost of 120 million. The factory commenced operation in January 2022. So it was at the beginning of the year when it commenced the operation. So the cost of the factory comprised the following: factory building, we had the office with the factory building, within the factory building, reinforcement of concrete floor to affix machinery, land, architectural fee, parking bay, electrical wiring, conveyor belt, lift and escalators, and special shaft for lifts. All that is the cost that was incurred at 120. Cost that was incurred totaling to 120 for that particular factory. So we shall look at it one by one, which one qualifies and which one does not qualify. Additional structures and works constructed and utilized from January 2022 as follows: residential house, workplace nursery, and drawing and design room. Drawing and design room. Then, to improve performance in the factory, an Oracle database that provides cloud service was installed at a cost of 1125. The computer in the drawing and design room had a computer-aided design application installed at a cost of 675. A building that has been constructed at a cost of 30 million was leased from Salama manufacturers for 5 years. The annual lease rental was 7 million. Musemi imported processing machinery from China at a cost of 13 million and installed it in the building. So it was installed in the building. 2 warehouses were constructed at a cost of 56.25 and utilized from 1st of September. 1st of September. What you'll note is that we normally apportion the IBD. We apportion it for the period of use. The following assets were purchased. The following assets were purchased or constructed during the year. So I've been given these are the assets: the fixture, furniture and fittings, including 550 for the workplace nursery, library fixtures stocked with the mechanical engineering volumes, computer and electronic adding machines, motor vehicle second hand, lorry, 4 tons, 4 tons, tuk-tuk for messenger, backhoe, loader, then additional processing machinery and a mobile crane. So you are required capital allowance due to Musemi for the year ended 31st December 2022. So just need for 1 year. In this case, December 2022. That's what we need, because they commence operation in January. They commence the operation in January. So we shall do the same thing that you have done. The same thing, starting with investment allowance. Allow me to do it on this on this end. Investment allowance, ID, investment deductions, this ID, investment deduction. I can use a second to copy something that we need is root. I'll just copy this and apply it in the first one. Apply it here. I think that one is okay. The details, qualifying cost, ID at 50, then the residue. So here we don't need what? The second, it's only for 1 year. So this one is out of order, only for 1 year. So the details, qualifying cost, ID at 50, and the residue. So we first do one and we finish, then we do the next. So depending on the size, and let me first do one for ID, investment deduction. investment deduction. So we look at the factory, the cost of the factory, which was 120, but within the factory building itself, within the factory that was constructed, the factory building was 46. This one. We had an office within the factory building, then reinforcement of concrete floor to affix machinery. This one should be part of machinery. Land does not. Architect certificate, parking bay, that one qualifies. Electrical wiring, conveyor belt, lift and escalators, and special shafts for the lifts. All those will qualify apart from land. Apart from land, in this case, land does not qualify for any. Remember, even in financial accounting, we don't depreciate land. Ideally, land appreciates. So in this case, land does not qualify for any capital allowance. Even architect fees, architect fees will not qualify for any capital allowance. This one will not qualify for any capital allowance. Electrical wiring, we shall see that. Yeah, the rest are understandable. The rest are direct. So we shall deal with factory building first. Factory event reinforcement, yeah, this one should be part of machinery because it is what we call the installation cost. We have to first reinforce where we shall put it. The factory building will remain here. Items that do qualify. The first item will be factory building. The second item that will qualify, office will not. Parking bay qualifies for ID. Parking bay, electrical, conveyor belt, all these are for ID. Lifts, the lifts, and even the shafts, special shafts for lifts, that one will go hand in hand. I think that's all. Lift and escalators, conveyor belt, electrical wiring will not. The parking bay, we have included that. Architect will not. Land, no. Reinforcement, where is the machinery? We bought machinery. So let me see whether we had. So here we don't have machinery, but they are saying the reinforcement of concrete floor to affix machinery. I think there was somewhere there was machinery. Yeah, the semi-imported processing machinery. We shall come and deal with that. Yeah, we shall deal with that. First, we deal with this. Our qualifying cost. The first one is this one, factory, followed by parking bay. Followed by what? The parking bay. Yeah, parking bay. Conveyor belt. So conveyor belt will be 3,000. We have less than a minute. When we switch, we log out, we come back to complete this question. Then we had what else at the beginning. So we have lift and escalators. For ID. Yeah, so that one we are calling the 10%, rule, the 10% rule, whereby we are looking at the non-industrial part, which includes the showroom, the warehouse, offices, and worker dwelling places. We are saying they will not qualify for either ID or IBD unless its cost is 10% or less of the entire cost of the factory building. So it is let me change this. Factory building, that way. So that now in this case we have calculated our 10% rule. Just to confirm whether it is more, we have seen it being more. So 15, we have taken 15 divided by 46, the entire cost of the factory building that we are having here, without the other accessories or other elements that are attached to the factory building. So that is the none. We are just eliminating that non-industrial part, but the other industrial part, we shall calculate them separately. And already we have started with the factory building, parking bay, conveyor belt. We had lift and escalators. The lifts and the what? The lift. This is wrong. The lift and the special shafts for the lift. This one, they will go hand in hand. The lift and special shafts, they cannot be separated. Both of them, they do work at the same time, the lift and the special shafts for lifting this particular ship, this particular lift. So those, I think, they are the items in the first balance that do qualify for ID, the factory. For the reinforcement, we shall deal with this one, reinforcement of concrete. We shall use that for calculating ID for the machinery, because it was specifically for fixing the machinery. Architect, we have said, is no land, no parking bay, electrical wiring. Yeah, for the wiring, okay, we shall see that conveyor belt we have included, and lift and escalators and the special shaft. So we calculate 50% of this, 50% of this, 50%, and you get the balance. You get the balance, the minus the 50%. Okay, this one I just need to drag, even this one, to get the residue, which is equivalent to the ID, because it's 50% that is being retained. Then other ID that were purchased, we have residential house, workplace, nursery, drawing and design room, all this will be under IBD. Then there was this part, a building that had been constructed at a cost of 30 was leased from Salama Manufacturers Limited for 5 years, that is for lease. Annual lease rental were agreed at 7 million. Musemi imported processing machinery from China at a cost of 13 and installed it in the building. Yeah, so we shall have processing machine. But now for the processing machine, what we shall do for this machine, our qualifying cost will be the initial. We bought it for 13. And the shillings, and the shillings in thousand, I will show that. 13, and you add this cost that we had, the reinforcement of concrete. Reinforcement of concrete, include that. The reinforcement of concrete, you need to put shillings in thousand. Yeah, that way. That way. So that for the processing, we have taken what we bought. We bought processing of 13, and we have added the reinforcement of concrete, so that we can be able to do what? To fix this particular processing machinery. That is part of the installation cost. And any other, so that we drag the others that we are leaving, they'll qualify for the what? The card, it will be under wear and tear. These are softwares, wear and tear. The two warehouse, so again that one is under the IBG. So the following assets were purchased or constructed during the year. So we have furniture, library, computer, motor vehicle, lorry, tuk-tuk, backhaul loader, that is under category 1, additional processing machinery. So we had this one, additional processing machinery. We shall account for it here. Additional processing machinery, even that one will qualify, because the processing machinery will qualify for the 50%. Will qualify for the 50%. That one, and I'll just drag this. I'll drag this. Yeah, that way. And that is the first part of getting the investment allowance. So the only thing, let me just confirm for you the electrical wiring. Whether wiring qualifies for ID, whether it qualifies for ID. Electrical. Just a minute. So for the wiring, it will qualify for what? Yeah, we shall put it under wear and tear, not under ID. Under wear and tear at 10, because it's not categorically covered or shown. Yeah, and the backhaul loader. So the loader will be under what? The wear and tear category 1. Yeah, they are like the cranes. Yeah, these are heavy as moving. It should fall under this category. Just a minute. will fall under this one. The motor vehicles and heavy as moving. The one for 25, wear and tear. Yeah, the backhoe loader, because this is for loading items, whether it is soil or what we are loading. Yeah, that one will fall under the wear and tear, specifically category 1. So for the wiring is the one that I'm looking at it. Purchase, acquisition of rights to use fiber optic cables by telecommunication. Like for the fiber optic, assuming we are dealing wiring for that or any other electrical wiring, so still we shall deal with it at 10% per year. Yeah, category 2 for 10%. Category 2 for 10%. That's what we shall use. We shall place it under category 2. The wiring, wiring we shall place it under category 2. Backhoe loader we shall place it under category 1. Category 1. I think that's all. So we just need this. If there is anything, we shall add it. We shall add. The only item that is necessary is to add the ID. We are getting the total for that column of ID. The total for the ID. Then the next category is IBD, industrial building deduction. Industrial building deduction. Industrial building deduction. And still it will have the same, the details and these others, but here we shall have IBD at 10%. IBD at 10%, IBD at 10%, and the rest is the residue. Yeah, that way. So we calculate and we deal with that one. Okay. Yeah, I think that one is okay. So that for the IBD, I think I have seen several items there that qualifies for industrial building deduction. Starting from open parking bay, we have included it. Yeah, parking bay was an ID. Okay, conveyor. So under the first, this one, the residential house. So residential additional structures and works constructed and utilized from 1st January 2022 was follows. So this one were constructed. So we have residential house. We have the workplace. So first we start with the workplace nursery. Then the drawing and design room. All these are buildings. So for residential, it will not include it. Yeah, that's the residential. It's not for the business. Residential is not for the business, so it will not qualify for the IBD. It will not qualify for the IBD. Then to improve performance, that one will go to wear and tear. All those are for wear and tear. So processing already we have included that. Okay, then 2 warehouses were constructed at a cost of 56.25 and utilized from September 2022. So here we have warehouse, and for this warehouse, the qualifying cost was 56.25. Because we are dealing with shillings in thousand. Okay, here 1,000. Yeah, that way. So for the design room, design was 1.8, and the nursery was 2.4, not 2.4, but 3 for the nursery. Nursery will be allowed, or it will qualify for the IBD because it's the workplace nursery for the young mothers that are coming with their children. Then 2 warehouse, we have dealt with that. The only thing we shall calculate from September. So the following assets were purchased or constructed during the year. So we don't know the duration, but head furniture, that will go to wear and tear. Library, computers, wear and tear. Yeah, wear and tear. So majority of them Yeah, all of them apart from the additional. I think here we had only these items. So this one at 10%. I'll drag these two. So here we just get the balance. Just get the balance. Okay. So that for this one, we shall take this by 10%, and you multiply by the duration. It was utilized from September, October, November, December. They are 4 months. October they are 3. Yeah, but from September they are 4 months during the year. IBD we apportion. IBD you are allowed to apportion, but the rest you are not. IBD is the only one that you can apportion, depending on the period of use. Depending on the period the asset was applied or the asset was used, you shall apportion that. Then I think that was all. Under this, get IBD will be 668. I think it has rounded it off. Power of rounding off. Then we enter. Unless there is any other, just don't worry. If there is any other thing, we shall add a line. Wear and tear, allowance, wear and tear allowance. So the same, the details and the qualifying cost. Okay, so this one doesn't follow the same category, sorry. We shall have category 1, category 1, category 1. We shall have category 2, category 2, category 2, category 1 and category 2. That way. This is category 1. That way. So that with that in mind, we shall look at items that qualifies for these two categories. For these two categories. So the first one that we have, we have seen it. We had all those were used, lift, all those were used, and yeah, we had to improve the performance of the factory. An Oracle database that provides cloud service was installed at a cost of 1125. So database will be part of the software. Database Oracle database was installed at a cost of what? For that particular database. So for the database, we are told it was 1125 shillings in thousand. 1125. This one here, 1125. Computer in the drawing and design room had a computer aided CAD application installed at a cost of 675. Yeah, then CAD application that is computer aided design. CAD application computer aided design of 675. All these are softwares which qualifies for category 1 at 25%. Initially they were having a special rate of 20%. They used to have a special rate of 20%. After that, we have a building that was leased, but in the, okay, leave alone that first. Warehouse, we have dealt with it. So we have furniture. Just write the furniture instead of pasting it. Furniture. So for the furniture that we had furniture in category 2, furniture of 1550. Then we have library fixtures. The same thing under category 2 for the fixtures, library fixtures. Then we have computer and electronic. So that is office equipment of electronic in nature. Yeah, computer and electronic adding machines. Category 1 qualifies for category 1. Then computer and electronic, I think that one you have dealt with it. So I think I've picked the wrong value. So computer should be 21, not 12 here. it should be 21. We had motor vehicle, second hand BMW. So long as the owner had not finished or completed claiming the capital allowance, the new owner will continue claiming the capital allowance. Then you have lorry. All these others apart from the machinery. So we had lorry, 4 tons. Let me fix this. Yeah, that way. So the only thing that we shall eliminate is 82. That one, and I think that's all under that we are eliminating. So the lorry, qualifying cost for the lorry, we had 7,000. Then these others, tuk-tuk. Yeah, tuk-tuk is in which line? This one. So tuk-tuk was 450. So lorry for 4 tons already have included. So backhoe, loader, yeah, that way, and mobile crane of 47. Remember, the fixed crane goes to the last note, or in the category 2. If it is fixed, it's not movable, we put it under category 2. But if it is movable, like in this case, we put it under category 1. I think we're done with that. Backhoe, tuk-tuk, lorry, motor vehicle, second-hand, computer and electronics, so library, fixtures, and furniture. So the only thing that we have not dealt with is a building here. A building that had been constructed at a cost of 30 was leased from Salama manufacturer for 5 years at an annual lease of 7. So for this one, now, when you are leasing, you don't own the asset. You only have what you call the right of use. And therefore you cannot claim the capital allowance on leased asset. You cannot claim capital allowance on leased asset. The owner is the one that will claim. The owner is the one that will claim that. And therefore I think that's all that we have covered. Yeah, I think wiring we had said about that. I had forgotten wiring under category 2. Wiring, electrical wiring of 37. Electrical wiring of 37. Wiring of 37. I think the others, all of them, they have been captured somewhere. Okay, so that way. That is item. If you see items that have not captured, kindly notify me. So for the residential house, we have said that one will not qualify. Yeah, residential house will not qualify because that's non-business. We are only claiming it for business purpose. And I'll get the total up to that point, less otherwise. So here the total, which you are calling the qualifying cost, qualifying cost here, qualifying cost. I'll get the total for the second. Yeah, imported machinery. I think we included it. Imported machinery, we included it under what? This one, the processing machinery. Processing machinery of 17. 17 was inclusive of 2 items. This one, it was 13,000 that was imported here. Musi imported processing machinery from China at a cost of 13. So what we have not been given is the custom duty. We normally include the custom, but we have not been given the custom. So we took 13 and installed it in the building. So when we install it in the building, that's where we incurred this reinforcement of concrete floor to affix the machinery. So that means that this one you can call it the installation cost, fixing or reinforcing the floor in order to do what? To fix the machinery, and that's why we have added 13 plus the D12 to get the value that we got at 17. So we already captured that. Thank you, Peter. That one was already captured. So this will be our qualifying costs. that way. So qualifying cost, then you calculate the wear and tear, allowance, wear and tear allowance at 25. Remember the category 1 here is at 25%, and category 2 here is at 10%, 10%, that way, at 25 and at 10. So this will be this value multiplied by 25%, and I'm supposed to put a minus that way, and this other one will be this negative this. You multiply by 10, which will give you 645. So written down value, carry down the sum of the two, and this one we just drag that way. We use the top and bottom border, the thick one, yeah, that way. And that's how you deal with that question for capital allowance due to Musi. So we had investment there 47, IBD at 668, and wear and tear these two. These two are for wear and tear. You can just bold that, and I bold this. So the bold is the item, the figures. If you are preparing the financial or the statement comprehensive, the statement, adjusted statement of profit or loss, these are the values that we shall deduct under less allowable deduction omitted. Yeah, the one figures that are omitted from calculating the taxable income. So we shall deduct ID 47, we deduct IBD 668, we deduct wear and tear, the sum of the two, 7762 and 645, or you can decide category 1 and category 2. But generally, that's how the question for investment allowance are done. So there are questions that you cannot miss your marks. You can get maximum number of marks if only you know the items they are qualifying for what. And we've said the major three. These are the major three: investment deduction, industrial building deduction, and the wear and tear allowance. Allow me to stop at that point. You will attempt the question for partnership. Yeah, the question for partnership. Yeah, just go through that question for partnership so that you can remind yourself. I'm still in the process of compiling other, especially for the weekend, because it's a long weekend. I will compile other questions that you will still attempt them. And when you are done attempting, kindly share back. I will create time and look at them. That's all. And that is taxation. Yeah, specialization area for taxation. I think we have covered it extensively. So that in the next lessons for next week, we look at the theory and the past paper questions for the theory and any other area. So theory is part of the revision that we shall be starting at, looking at the theory overview of it and answering questions directly from the theoretical and moving forward. That's all. Good night, and have a lovely Easter. Yeah, have a lovely Easter holiday.